Good evening, ladies and gentlemen. A very warm welcome to ICICI Lombard General Insurance Company Limited's Q4 and FY22 earnings conference call. From the senior management, we have with us today Mr. Bhargav Dasgupta, MD and CEO of the company, Mr. Gopal Balachandran, CFO and CRO, Mr. Sanjeev Mantri, Executive Director, Retail, and Mr. Alok Agarwal, Executive Director, Wholesale. Please note that any statements, comments are made in today's call that may look like forward-looking statements are based on information presently available to the management and do not constitute an indication of any future performance, as future involved risks and uncertainties which could cause results to differ materially from the current views being expressed. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone phone. I now hand the conference over to Mr. Bhargav Dasgupta, MD and CEO, ICICI Lombard General Insurance Limited. Thank you, and over to you, sir.
Thank you, Nirav. Good evening to each one of you, and thank you for joining the earnings conference call of ICICI Lombard General Insurance Company Limited for Q4 FY22 and for the full year 22. I will give you a brief overview of the industry trends and developments that we have witnessed in the last few months. Post this, our CFO, Mr. Gopal Balachandran, will share the financial performance of the company for the quarter and the year ended March 31, 2022. The industry registered a GDPI growth of 11.1% for FY22. As per public disclosures, the combined ratio of the industry was 119.2% for 9 months FY22 as compared to 110.4% for 9 months FY21. And the industry reported a loss of 4.05 billion rupees as against profit after tax of 55.6 billion rupees for 9 months FY21. Further, the overall combined ratio for the private multi-line general insurance was 112 in 9 months FY22 as compared to 104.6 in 9 months FY21. The industry's solvency at 9 months FY22 worsened to 1.71 times as against 2.07 times at 9 months of FY21. So moving to the quarter under review, the industry delivered a mixed performance. As per the data published by CM, the new vehicle sales witnessed tepid growth of private car segment on the back of supply side challenges. The two-wheeler segment remained far from recovery, while the commercial vehicle segment has shown growth supported by underlying demand. Health insurance, on the other hand, contributed significantly to the overall industry growth in line with the expectation and is now the largest contributing segment to the GDPI of the industry. The commercial lines witnessed robust growth in sync with current market environment. Coming to the business impact for us, the company has grown in line with the market growth of 12.7%. This is excluding crop and mass health, as against the lower growth that we witnessed till 9 months of FY22. Within the quarter, the growth momentum has increased each month, and the company has significantly outgrown the market in the month of March 2022. Coming to the growth for key segments during the quarter, for motor, the company has grown faster than the industry, and we have now attained market leadership in this segment for the year. Our investment in the retail health side has started to show results and has resulted in our agency channel premium growth of 29.5% for the quarter. As indicated in our previous calls, of the 1,000 retail health agency managers to be added to our employee base, we have now onboarded 750 of them during this fiscal, and the balance 250 offers have been made. We expect the growth to accelerate in the next few quarters as the sales force starts getting productive. The corporate agency channel, including bancassurance, is back in the black with overall growth of 19.4%. Within this, ICICI Bank distribution grew by 24.9%, primarily driven by health indemnity, SME and motor business, and other distribution partners acquired through the integration grew 15.9% during the same period. Our business sourced through our website grew by 20%. Within this, our health business grew by 23%, travel grew by 130%, and motor grew by 10%. Business sourced through strategic alliance partners in the digital ecosystem grew by 98.2%. Overall, our digital solutions has enabled us to increase our digital revenues to 7.74 billion for the current year, which accounts to 4.3% of our overall GDPI. As for the commercial lines are concerned, we experienced robust growth driven by 17.8% growth in the SME segment. Let me now give you an update on some of the other key initiatives. On the integration, I am very happy to share that as we speak, ICICI Lombard stands as the second largest non-life insurer in India. Exactly as envisioned while evaluating the scheme as a potential transaction, the integration enabled us to strengthen our market leadership, augment and further strengthen our diverse distribution channels. The revenue and operational synergy plans are on track, and Gopal would talk about this in detail in his segment. Our I'll Take Care app has surpassed 1.3 million downloads with successful submission of over 130,000 claims and over 70,000 teleconsultation requests. The recently added feature, Face Scan, helps users to keep a track of vitals such as blood pressure, heart rate, respiration rate, etc., all without any additional devices and from the comfort and safety of one's home. I'll Take Care is built to be user-friendly and a continuous engagement platform, which is increasing our ability to cross-sell. We are also pleased to share with you that we are the first large insurer to move our entire core systems onto the cloud this year. In our data center, we had about 110 applications across 600 servers and around 1,000 terabyte of data. Moving our complete setup onto cloud has given us some immediate benefits, including stability, availability and scalability. As such, some of the investments that we have made during the year in distribution and technology is bearing fruit, and we expect to see momentum in growth as we head into the next financial year. We intend to continue with our expansion across distribution, digital, technology and claim services. Towards this, we have planned additional investments in the range of rupees 1 billion to rupees 1.5 billion during the coming year. I will now request Gopal to take you through the financial numbers for the recently concluded quarter.
Thanks, Bhargav, and good evening to each one of you. I will now give you a brief overview of the financial performance of the company for Q4 and FY2022. We have put up the results presentation on our website. You can access it as we walk you through the performance numbers. The effect of the demerger in the financials have been incorporated in the form of opening net worth as on April 1, 2021. Further, the financials for the current year represent numbers of the merged entity, and the comparative numbers for the previous year in the financials pertain to standalone ICICI Lombard and hence not comparable. The company has enhanced disclosure requirement of reserving triangles by giving separate reserving triangles for motor third party and non-motor third party lines of businesses. This is in accordance with the regulatory guidelines on public disclosures, which is applicable to all the players in the market. You may refer to slide number 29 and 30 of the investor presentation on the reserving triangle disclosures. Our gross direct premium income of the company was at rupees 179.77 billion in FY 2022 as against rupees 140.03 billion in FY 2021. The industry reported a double-digit growth of 11.1% on a lower base for a similar period. Our GDPI growth was primarily driven by growth in preferred segments, given that our approach has always been growing business sustainably. The fire segment GDPI was rupees 27.5 billion in FY22 as against rupees 21.58 billion in FY21. As indicated in our results presentation, the overall GDPI of our property and casualty segment was rupees 50.24 billion in FY22 as against rupees 39.29 billion in FY21. On the retail side of business, GDPI of the motor segment was at rupees 82.8 billion in FY22 as against rupees 70.2 billion in FY2021. To harness the potential of these segments, we have been expanding our distribution network to increase penetration in Tier 3 and Tier 4 cities. Our agents, which includes the point of sale, has increased to 88,539 as on March 31, 2022 from 81,969 as on December 31, 2021. The advance premium numbers was rupees 33.68 billion as at March 31, 2022 as against rupees 34.59 billion as at 31st December 2021. Resultantly, combined ratio was 108.8% in FY22 as against 99.8% in FY21 and 111% in 9 months FY2022. Combined ratio was 103.2% in quarter 4 FY22 as against 101.8% in quarter 4 FY21 and 104.5% in quarter 3 FY22. Our investment assets rose to rupees 387.86 billion at March 31, 2022 from rupees 374.54 billion at December 31, 2021. Our investment leverage net of borrowings was 4.23 times at March 31, 2022 compared to 4.23 times at December 31, 2021. Investment income was at rupees 7 in FY22 as against rupees 21.96 billion in FY21. On a quarterly basis, investment income was rupees 7.06 billion in quarter 4 FY22 as against rupees 5.37 billion in quarter 4 FY21. Our capital gains was at rupees 7.38 billion in FY22 as against rupees 3.59 billion in FY2021. Capital gains for quarter 4 FY22 was at rupees 1.36 billion as against rupees 0.66 billion in quarter 4 FY21. The successful integration of the demerged business of Bharti AXA into the company has led to optimization of our organizational structure, rationalization of offices, efficiencies in claim settlement practices and technology applications. This will result in an annualized synergy benefits of rupees 2 billion, of which rupees 0.7 billion has been realized in FY 2022. Our profit before tax was rupees 16.84 billion in FY22 as against rupees 19.54 billion in FY21, whereas PBT was rupees 4.1 billion in quarter 4 FY22 as against rupees 4.5 billion in quarter 4 FY21. As explained above, the company has seen higher growth momentum in Q4 FY22 and within that in the month of March 2022. Due to the current accounting norms, this results in upfronting of sourcing costs, whereas the benefit of earned premium will be realized over the policy period. Consequently, profit after tax was rupees 12.71 billion in FY22 as against rupees 14.73 billion in FY21, whereas profit after tax stood at rupees 3.13 billion in Q4 FY22 as against rupees 3.46 billion in Q4 FY21. The Board of Directors of the company has proposed a final dividend of rupees 5 per share for FY 2022. The payment is, however, subject to approval of shareholders in the ensuing annual general meeting of the company. The overall dividend for FY22, including the proposed final dividend, is rupees 9 per share. Return on average equity was 14.7% in FY22 as against 21.7% in FY21. The return on equity for Q4 FY22 was 14% as against 18.8% in Q4 FY21. Solvency ratio was at 2.46 times at March 31, 2022 as against 2.45 times at December 31, 2021, which continued to be higher than the minimum regulatory requirement of 1.5 times. As I conclude, I would like to reiterate that we continue to stay focused on profitable growth, sustainable value creation and safeguarding interest of policyholders at all times. I would like to thank you all for attending this earnings call and we will be happy to take any specific questions that you may have. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Shreya Shivani from CLSA. Please go ahead.
Hi, thank you for the opportunity. So a couple of questions I had. I'll probably just take 2 and then get back in the queue. First one is on the TP hike rate that was announced and what is your feedback on how comfortable are you with the kind of hike that the regulator had proposed? And if you can help us get to an idea, in spite of the hike, I think given that the underlying car sales is still weak, if you can help us understand how much proportion of your motor TP book is private cars. That would be the first question. Second is on your, so just looking at your March 22 data, the monthly data. So the trend in your motor TP book was quite strong, and it was stronger than the industry for that matter. So if you can give me, so if you can help us understand that. And lastly, on the loss ratios for fire, it's come down quite dramatically in this quarter. So if you can help us understand that. These are the questions.
Thanks, Shivani. So let me take the questions and give the answer in the same sequence. So if you look at the PP rate hike, it's different across different segments, but the long-term PP rates hike is a bit higher. Overall, at a portfolio level for the industry, weighted average increase comes to roughly about 3% plus minus. Honestly speaking, given the general inflation that we see, we would have liked to see slightly higher rates in certain categories. In certain categories, we are fine with the rate hike that has been given. So in aggregate, maybe a little bit higher would have been appropriate is our view on this. When is it expected? As of now, the understanding is that it will come around May. So that's where we are on the PP hike. In terms of the mix, I'll ask Gopal to answer the mix point on the private side.
Yeah. So, Shreya, as you can see, so far as we have given on the slide the split of OD and TP, which is roughly about 40.68 billion is own damage and about 42.12 billion is third party. Within that 42.12, private car third party will be about 13.49 billion.
Coming back to your question on growth, I think what's happened, as we've been kind of explaining for the last few quarters, is that we took some calibrated call on readjusting our portfolies away from certain private car segments, given the pricing competition that we saw on the private car and the own damage side, and increasing on the CV side. Again, very calibrated, very selective calls based on ground level insights plus some experimentation that we've been doing for the last 3 years to figure out if some of those books are going to be better risk for us. Now, when in retail, when you cut down, the number goes away immediately, but to build up it takes some time. So I think on the commercial side, the growth momentum has now picked up, and what we've been kind of indicating is that if you look at our overall portfolio mix, unlike the market, where out of the total motor book, roughly 45% would be commercial vehicles. For us, that was in the teens, 15 to 17%. That, as we've been saying, that should go to roughly in the mid-20s. So that journey has now started. We will have to see if we can maintain the momentum of growth of March, but clearly the increase in the market share of CV is something that we expect going ahead.
And your last question on fire loss ratios, Shreya, again, I think that's one segment where we keep talking about saying that a quarterly loss ratio may not necessarily be reflective of the underlying outcome of the performance. The better number to look at will be more, I would say, financial year numbers. In fact, within that, I mean, there could be years where because of, let's say, various large losses or catastrophic years, in fact, the loss ratio of that particular risk segment could get impacted. So hence, quarterly numbers may not necessarily kind of reflect, as I said, the underlying outcome. Look at more the annual numbers for the fire part of the business.
Got it. Okay. Thank you.
Thank you. The next question is from the line of Abhishek Saraf from Jefferies. Please go ahead.
Yeah, thanks for the opportunity. So I just had a few follow-on questions from the earlier question asked. So you mentioned that in the CV we are looking at a higher mix in the. So what is giving us confidence in terms of meaning or containing the loss ratios in that? If you can just give us a few more details in the kind of experiments that you have run and means where are we deriving this confidence from? Secondly, if you can help me understand, I believe that we have taken hikes in motor OD segment. So what would be the average quantum of hike that we would have taken, and which kind of car segment, and is it across the board that we have taken in the new or basically in the sense that for new cars, or is it across the board for new and old cars? I have a few more questions after this. Just after, if you can answer this, I'll follow up here.
Yeah, thanks, Abhishek. So in terms of the I think we've been talking about what the way we've handled this. Again, if you reiterate the point, it is not as if we believe the whole CV portfolio is suddenly turned viable or sustainable or profitable. If you look at the overall industry mix, CV will be, as I said, between 45 to 50%. We are not talking about going anywhere near that number. Now, what we've been doing for the last 3 years, again, at various times we've talked about this, is that based on ground level insights, based on some changes that we are seeing both in certain micro segments, certain markets, based on certain usage patterns or accident patterns that are changing in certain states, or even some amount of the regulatory and the compliance standards in some of these markets, we have been identifying some segments that we believe are viable today than with what they were in the past. And what we've been doing as a company is that we've been taking small bets to see, writing small amounts of business, reserving at a level where we believe, it is very, very conservative, but allowing the team to write some of those businesses to see what is the experience that we have over the next 2 to 3 years. Some of those experiments have proved to be in line with our expectations. Those are areas where we are scaling up businesses. So that's the confidence that we are getting in terms of the segments of business. Now, in terms of, and the approach that we are taking is not just a loss ratio. You're not looking at loss ratio. You look at the combined ratio in terms of sourcing cost and loss ratio together. And wherever there is more viability, that's where we are taking those calls. In terms of private car, the increase is reasonably across board. There are 1 or 2 OEMs which haven't agreed. We are discussing, but most of the areas we've taken price increases.
Thanks for that answer, Bhargav. Just if you can help us understand, if you can share the quantum of hikes on an average that we would have taken.
It will be single digit ratio. It's not as if we've taken a huge hike. It will be a single digit hike.
Okay. That's very helpful. Secondly, just noticed that in the calamity losses, our share of losses have actually gone up in this year. So is it only because of integration with Bharti AXA, or is there more to it? So if you can help me understand, is our share of premium also have gone up proportionately in line with the losses as well?
Yeah, so this was largely the cyclone Tauktae that you're talking about. If you look at the last 10-12 cats, our share of losses has been significantly lower than our normal market share. In Tauktae, we had 2 of our corporate exposures that got hit, so it was kind of a unfortunate concentrated event, not as if there was a large impact across board. So that's why we have an impact in the Tauktae, because in those cases we are in the Western market where we have a slightly higher share than our natural market share. So when you look at let's say loss share that we've got relative to the market share in these markets, they get lower.
Yeah, thanks, Bhargav. That's very helpful. Thanks a lot.
Thank you. The next question is from the line of Madhukar Ladda from Elara Capital. Please go ahead.
Hello, am I audible?
Yeah,
yes,
Madhukar.
You are.
Yeah. Thanks for the opportunity. So, your OD loss ratios for OD and TP, and especially TP actually, for Q4 have risen quite materially. And if you look at the quarter by quarter trend, there is quite a bit of volatility. Now, when we look into the future, how should we be thinking about it? Should we be thinking more in terms of, exit rate will be more appropriate for next year, or the full year rate as a base? And so what sort of, how do you sort of project these things, or how do you look at it?
So Madhukar, so if you look at on the motor own damage segment, I think to my mind, when you look at more the exit rates for quarter 4 will be largely reflective of the trend line that one could potentially see so far as the way forward is concerned. And the reason why we are saying is in line with what we had discussed even in our earlier calls. The thought process is to try and see how we can get significantly into writing businesses which will be relatively driven insofar as more on, let's say, high loss ratios and relatively lower cost of sourcing led businesses. That's the thought process that we have in terms of increasingly building the book. And that's the reason why I would say quarter 4 on the motor own damage is largely reflective of what one could experience, at least insofar as the trend line for the future is concerned. Having said that, obviously we continue to kind of micro segment the portfolio to see which are the segments which we want to select and underwrite in terms of building the overall book. But the thought process is in line with, as I said, build a book which is relatively high LR and low expense insofar as cost of sourcing is concerned. On the third party portfolio, I think what you could, the full year numbers are largely representative of what one could experience insofar as the way forward is concerned. Quarter 4 specifically, I think in line with what we had done in quarter 4 of last year, if you recollect, I think there were those Supreme Court judgments which had come through. This is which we had to kind of revisit all the outstanding cases that we had as of the previous year, and we had to kind of strengthen the reserving requirements, assuming the fact that we could expect an increase in average claim payout consequent to those judgments on the outstanding cases as well. On the similar lines, I think what we have experienced over the last couple of years, which is for understandable reasons, that the courts in India, which is predominantly where you get bulk of the motor third-party orders being received, that has not been functioning at full force. While we have started to see, particularly maybe quarter 4, we have already seen things coming back, but at least over the last, I would say, 3 to 6 quarters, the courts have not necessarily been functioning at full swing. What this does is obviously it kind of starts to have an impact insofar as the trend line of settlements or closures of cases of third party that we would have done relative to the historical past. Which would mean, obviously, given the fact that there has been some lag insofar as the extent of closures that we would have normally seen, which could happen in the future period, we obviously have to kind of factor in for, or maybe build in an element of further inflation assumption as a part of our reserving book. Particularly the element of interest that we will have to add insofar as our reservings are concerned. And hence, the trend line for Q4 on the third party book will be more representative of what one could expect so far as future trend line is concerned. That's what I would say.
Q4 even for TP is what?
Yeah, and the other aspect I think one should also be mindful, Madhukar, is I think given the fact that we have also strengthened the reserving book of the motor third party pool, as you would have seen in terms of the enhanced disclosures, this element of increased interest or inflation that we will have to build in as a part of the reserve has obviously led insofar as the erstwhile motor pool book is concerned, we have obviously strengthened the reserve. However, on an aggregate basis, we have motor third party which is actually reflecting a small amount of reserve releases.
Got it. Also, then
just to add to what Gopal said, so effectively what we are looking at is the combined rather than just the loss ratio when we are selecting business, and the attempt is to bring the combined more under control, not just look at the loss ratio.
Right. I'm guessing the comparative intensity is driving us in this direction. And that's why we are seeing slightly probably lower commission ratios and expense ratios in 4Q. Would that be right to say? And what would be like the trend for FY23?
So more than the competitive intensity is overall driving up the overall combined for motor. But if you look at from a pure ROE perspective, businesses which are high LR but low expense ratio are better businesses because the expense is upfront. LR comes over the period.
Right. And our expectation on how, like the integration with Bharti and what should be our expense ratios and what sort of expense ratios should we expect in FY23, 24, like any guidance on that?
So in terms of synergy numbers, Gopal has explained.
So very difficult to put out a number, Madhukar, because I think on the one side, as we have put out what will be the annualized synergy numbers which we put out as a part of the opening remarks, which is rough.
I missed that. I think I missed that. Sorry.
Yeah. Having said that, I think what we will continue to do when we look at, let's say, FY23 or maybe the year thereafter, we will want to continue to kind of stay invested in building some of our expansion plans, particularly what we have spoken about on, let's say, on the health agency distribution side. We want to continue to stay invested on building our digital opportunities that we see, including the investments in technology and claim service. So to some extent, I think largely what we would end up is obviously we are pretty much on track in order to kind of realize the benefits of synergy. But at the same time, we would want to kind of use some of these to kind of increase the opportunity that we see on account of the renewed growth momentum that we have seen for ourselves.
So if you remember what we had discussed when we did the transaction, we had said that for a couple of years our combined ratio will be elevated and then it will start coming down. If you see our combined ratio for this quarter, it's related to the last 2 quarters, it's already trending down. So that is an ongoing effort that we will make to keep the combined ratio under control. Now we've also said that as a strategy, rather than bringing combined down to 100 and delivering a 20% ROE, we want to keep on investing and grow the book a bit faster. Consequently, the ROE may have come down to the high teens. But directionally, a clear improvement in combined, that should continue.
Understood. And final question, I was reading the notes to accounts. There is a 65 crore payment of GST under protest and an additional agreement to pay 40 crores. Can you explain that? And what is this the result of and the implication, if any?
Yeah. So these are a couple of matters as what we have put out as a part of that disclosure on the notes to accounts. As an insurance company, we are entitled to claim input credit insofar as settlement of motor claims related expenses are concerned, both with respect to the arrangement that we have either on a cashless or whether on a reimbursement basis. Insofar as the GST department is concerned, I think they seem to kind of allege that possibly we are not entitled to claim certain inputs with respect to some of those motor claim related expenses. So that's one. The second aspect is again with respect to realization of as a part of claim settlement, again in the context of motor portfolio, we do kind of end up having certain element of salvages. The view of the department is that on that particular amount of salvage amount that we end up realizing, there should be an element of GST applicability on the extent of realizations that we have made. We have consulted the expert opinions as well as senior counsels on this in terms of the stand that the company has taken, both with respect to the eligibility of input credit on motor claims, as well as whether there will be any element of applicability of GST insofar as salvage related realizations are concerned. The stand of the company is pretty much well found and it is legally correct. So at this point of time, obviously that's the reason why the amount that of 65 crores is paid under protest, and another 40 crores is something that we are committed to pay. At appropriate point of time, in due course, we will be filing a refund for getting these amounts back. But at this point of time, these amounts are largely kind of paid under protest. What we clearly understand is obviously this is something which is applicable more at an industry level, and hence to that extent collectively the stand of the industry is something that we will work with and ensure that we are able to get the rightful amount that is due back to us.
Understood. So this is an industry phenomena. So the tax department is
absolutely. This is not specific to ICICI Lombard. Both the issues are at an industry level applicable to almost all the players in the market.
Got it. Thanks. That's very helpful.
Thank you very much. A request to all the participants, please restrict to 2 questions per participant. If time permit, please come back in the question queue for a follow-up question. The next question is from the line of Prayesh Jain from Motilal Oswal Financial Service. Please go ahead.
Yeah. Hi, good evening, everyone. Firstly, could you talk about the health claim ratios on the retail side in particular and also on the group health? How have they fared in Q4? And are they back to pre-COVID levels, or there are certain elements which are still there with respect to COVID? And how do you see this going ahead? I'll ask my second question after that.
So if you look at the split of the health loss ratios, which has been given in the aggregate on the presentation deck, the breakup of that in terms of the employer-employee portfolio, or let's say the corporate book, that number for quarter 3 was 93.1%. That number for quarter 4 is 95.3%. And on the retail indemnity book, the loss ratios in quarter 3 was about 65.7, and for quarter 4 that number stands at about 57.6%.
Okay. So my question was, while it has, the retail definitely has come up, and so this is more of a normalized level now, and we can presume it to be in a similar trajectory going ahead, right?
So when you look at, for example, on the corporate or let's say the employer-employee book, we have always spoken about saying that it typically, particularly the large corporates, tends to kind of operate at a loss ratio which could be ranging anywhere between 95 to 100, anywhere between that. And insofar as the relatively small and mid-corporate book is concerned, they generally tend to kind of operate on, again, the employer-employee part at anywhere between 90 to 95, which is why on a blended basis, I think one generally gets to see the loss ratios which are relatively around those 95% threshold. However, the cost of acquisition with respect to these businesses, particularly the large corporate, tends to be more direct, and hence to that extent on an aggregate basis on a combined ratio book, it becomes viable for us to underwrite. Having said that, I think over the last 3 quarters, we have been kind of talking through, particularly on the employer-employee book, given the fact that we have seen, particularly this year, the impact of COVID losses playing out. We have been effecting clearly price increases insofar as the renewal of the portfolio is concerned. While we had indicated a price increase in the range of 15 to 20% during our quarter 1 earnings call, but subsequently, as and when the actual renewals have happened, we have been able to cite realizations which have been slightly higher than that. And even with the increased price realization, we have been able to clearly hold on to, in fact, more than 90% of the renewals insofar as the employer-employee, or let's say the corporate book, is concerned. On the retail side, again, the thought process is pretty much similar. We continue to keep looking at the portfolio outcome in terms of what is the desired loss ratio of the book. In general, I think particularly in the indemnity book, I mean, depending on the kind of book that you write, the loss ratios could range anywhere between, I would say, 60 to 70% on a steady state, whereas the relative cost of acquisition in the initial periods would tend to be relatively higher given the investments that we are making on building distribution. So that's what I would say insofar as steady state loss experiences are concerned, both on the corporate health or let's say the retail indemnity book.
Thanks. So the second question is more broad level and a slightly longer term as well. So if you look at the efforts that players like you all have taken with regards to tech-enabled claim settlement processes on the health side or on the motor side, there have been several initiatives that have been taken. So do you see that this the benefits of these efforts will get more reflected in the pricing coming down, or it would translate into more combined ratio improvement? So what will be the strategy that ILOM will be adopting in order to take benefits of these measures?
So in terms of our long-term thought process, this is just what you're talking about is definitely correct, but it's only one element of what we are, how we are building this. So if you look at, for example, on our claims, on the health side, we had launched that AI-driven authorization, the ML engine for settling claims for corporates. That's currently running at a shade lower than 60%. We believe that number will keep increasing as we go along. But the approach is across multiple levels. So if you think about it, the entire approach with I'll Take Care was to look at an engagement and a continuum of care approach with corporates. And we believe there are multiple advantages of that beyond cross-sell, upsell, engagement, duals, etc. Even at the time of claims, we believe in the longer term we will see some benefits. So we are already beginning to see that more than 40% of our corporate client claims are coming, even reimbursement cases are coming through that app. What we've seen in the past is when we had moved the entire claim service in-house back in 2008-9, because we run the complete data and do a lot of analytics around it, we are able to control, we could at that point in time control frauds better. On top of it, we built a lot of capability, again, using artificial intelligence to identify fraudulent claims better. Now, as we digitize the entire journey, the ability to run those engines better becomes even, you have an ability to run those engines even better. So we are already beginning to see benefits in terms of fraudulent claims being managed better. Lastly, I believe if we can drive the video consultation, teleconsultation, as a model to even control unnecessary hospitalization, that could be additional benefit. So overall, there is a very comprehensive thought process in terms of using technology to both give better convenience and service to customers, and in the process improve our relative, loss costs for the health claims.
Thanks. That's very helpful. Thank you.
Thank you. The next question is from the line of Sanket Gora from Spark Capital Advisors. Please go ahead.
Thank you for the opportunity. The price hike which we have taken in motor OD, which we have said, is largely limited to new business, or we have taken price hike in the renewal premium too? And then just wanted to check whether it is just limited to cars or even
new private car, Sanket.
Okay, new private cars. So the quantum of price hike we have taken, will it help in improving the loss ratios, which are currently 68 in 22 and 73% in 4 quarters? So expected improvement in the loss ratio because of this current price hike?
We will have to see a few things. One of the things that we are watching very closely is the claim inflation, because the input costs are going up for everyone. So there is a risk that there would be a claim inflation. Though till now, in spite of the inflation, the team has managed it really well in terms of controlling the ACS, average claim size inflation. We are also, driving a lot of our non-OEM source policies through our PPN network. That number has really gone up this year. So, so we are trying multiple strategies to prevent that from going up. But fact of the matter is that we've seen significant increase in input costs. So there is a risk that there would be an inflation because of that. Now, if that happens, then we may not be able to see that, benefit. But our sense is that at this point in time, where the private car OD loss ratios are, it needs a price increase ipso facto, whether we factor in the inflation or not. So difficult to predict whether we'll see improvement in loss ratio. If the ACS inflation doesn't happen, the answer is yes, but we would have to guard against that.
But is this an industry phenomena, that price hike you are seeing across the pairs to happen? Or the reason I am asking is that is a potential risk for our market share loss if we are the only guys who have taken price hike?
We don't think so, because, if you see the market share, the recalibration that we had to do, we've effectively done this year. If you see our OD market share this year has gone down largely for that reason, right? Because we felt that the pricing was not adequate. Right. Where we are focusing on the effort that we are building in terms of our digital and agency channels, maybe some of the slightly older segment, we remain reasonably confident about holding on to our market share in an OD side. And something that we've been saying that, these 2 years have been unusual because, people have benefited from lockdowns at different times on the motor portfolio, right?
Yeah.
And traditionally, whenever we see pricing for 12, 18 months and then things, correct back, we were talking about a pricing correction requirement even before the pandemic, right? So market was, in our opinion, ready for that, and then because of pandemic, people felt no need because of frequency loss, came down. We believe the market will have to rebalance and correct this year, and we are seeing the stress. We are seeing that even with price correction that we are doing, we are holding on to our market share. You've seen our March numbers, and the trend line remains that way.
Got it. And just on the TP business, you said that the mid-teens of contribution of CV to the entire TP business will reach to mid-20s. So just wondering that, have you identified a particular product segment where you can increase that market or contribution to 10%? Whether is it like SPVs or auto rickshaws or Kalipilis, which are the segments which you have identified which will drive this increase in the contribution and so the loss ratios?
Yeah, so it's not just at that level of segmentation. It's significantly more granular, which obviously I don't want to get into, but we've looked at down to RTO level, parameters to take those calls, not just in terms of product category, obviously at an overarching level. But we've done a lot more deep analysis on the ground in terms of various factors we have beyond categories. And on that basis, we've taken this call. If you see our market share, it's not a 10% shift that we're talking about. As we speak, in the Q3 numbers already come to close to 20%. So we are talking about that number going to mid-teens, mid-20s is not that big a stretch. And as I said, when we started doing those experiments about 3 years back, and we've watched the data for the last 3 years, almost 80-85% of the experiments have worked out well for us. That's where we are kind of expanding. So yes, a lot more micro segmentation than just the type of vehicle that you're talking about.
Thank you. Sorry to interrupt you, sir. I'll request you to come back in the question queue. I request to all the participants, please restrict to 2 questions per participant. If time permits, please come back in the question queue for a follow-up question. The next question is from the line of Neeraj Toshniwal from UBS Securities. Please go ahead.
Yeah, hi. So wanted to understand what is the aggregate level height on the motor TP now, particularly with the change in mix towards CV at 20s, mid-20s, which you talked about.
Could you repeat? There's an echo. We can't understand what you're saying, Neeraj.
The motor TP height on aggregate level.
Motor TP hike?
Yeah, on aggregate level for us.
At a portfolio level, roughly about 3%.
Roughly about 3%, Neeraj.
Okay, and would that...
Sir, sorry to interrupt you, but your voice is not coming very clear. May I request you to speak through the handset?
Sure. Is it better?
Yes.
Yeah.
And how much of that will be change in mix within the motor TP with higher CVs? Would that material be different, or with the pockets we identified? I mean, we have grown substantially higher in the March in motor TP. So I wanted to get more sense how more sustainable it is and what kind of run rate we can expect going forward with the hike and with the increasing losses. So that would be kind of, nullifying each other might be, but what incremental gain we can get through?
Not sure about your question. It is still not clear, but if you're asking because of the TP price hike and the run rate of growth that we've seen in March, if it's linked. So if you look at the increases that is being proposed, we have to wait for the final increases. The increases for the long-term TP policy is a bit higher. So there our new business should benefit. The approach on the CV business is what we explained earlier, that we are picking up segments on a combined ratio basis. Maybe the expense ratio is a bit low, but the loss ratio could be a bit high. But in aggregate, our combined ratio is what we are focusing on in terms of building in a more disciplined manner.
Got it. And one more question on motor OD. You obviously explained, but I wanted more color that how are we looking if let's say price intensity doesn't go down. So how are we thinking about any other strategy in mind?
So as I said, we think it should, because as I was explaining, normally we've seen over the last, since detarification, we've seen these episodic, aggression in the private car and OD segment. It does not sustain beyond, 18 months, 24 months. This time it's been close to, 3.5 years. So 2 of those years have been pandemic. So we believe it is also driven by the fact that during pandemic people saved on claims cost. So if you look at the industry, we don't believe people can sustain these kind of pricing aggression for too long. But we'll have to see. And as I said, when we are taking price increases, we are sensing that market is also expecting something like this.
Okay. And on the last question on the retail indemnity with the agents onboarding, how much delta we can expect in terms of growth coming in and what timeline, if at all?
See, you've seen a delta in the month of March itself. We remain reasonably confident of sustaining that going ahead. In fact, as we explained that, when you hire agency managers, they come on board, it takes about 2 to 3 months for them to even build their channels of agents. And then the agents start getting productive. So as of now, we've only hired about 750. The balance 250, are expected to come in. And the initial signs in terms of the hiring of agents that they've done, if you look at this month, this quarter, we've added almost 8,000 agents plus for this quarter. So it's picking up. The traction is high. So there's no reason to think that this gap in outperformance vis-a-vis the industry should drop off. In fact, we should be able to build momentum. We are actually very optimistic about that channel that we are building. If you see just the last quarter, our agency channel has grown by about 29.5%. So I don't see a reason why it should be lower than that for next year.
Thank you. The next question is from the line of Chetan Thakkar from ASK Investment Managers. Please go ahead.
Good evening, sir. Sir, two questions. One is on the health side. Just wanted to understand how should we view combined over a longer term, both for group and retail put together, and the mix that you're targeting. The second would be on the 775 crore expense that is there in the shareholder account, which does not pertain to the insurance business. So what does that exactly pertain to?
Yeah, I'll ask Gopal to explain the second one, then
let me explain the second one, Chetan. I think it's not that those are expenses not related to the insurance business. That's more a classification requirement in accordance with the regulatory prescription. Just to kind of explain this, I think the regulator has laid down limits for all players in the market to comply with limits on expenses of management for the company as a whole. For ICICI Lombard, we are in compliance with those limits for the at an aggregate level. Having said that, what the regulator has also stipulated is individual limits for some of the sub-segments of businesses within the aggregate portfolio. And in case, if in any of those sub-segments, if the actual, based on the allocation of expenses that have happened to those individual sub-segments, in case if we exceed, then to that extent, from a classification standpoint, those amounts are separately required to be given on the face of the profit and loss statement, which is why you find a large amount being reflected there. But equally, when you possibly see the revenue account statement,
there is a counter entry there which I saw. Yes, that is moving from shareholder to policyholder and then moving back to
policyholder. Yeah, exactly. So it's more a classification requirement that is stipulated insofar as regulatory guidelines are concerned. But as I said, for ICICI Lombard at an aggregate level, in accordance with the requirement of regulation, we are in compliance with those limits of expenses.
That is helpful. That is helpful.
And coming back to your second question, first question on health. Look, at this stage, Gopal explained the corporate book. It is a high loss ratio business in the 90s, but the cost of sourcing is low. So it stays in the, just shade above 100, between 100 and 105. We continue to write that business because, that volume also helps us in terms of the network and all the other aspects. That's corporate relationships. Plus, we are doing a lot of work with the I'll Take Care app with corporates to see what we can do in terms of cross-sell and upsell. So that's something that we want to stay invested in, but that's the kind of range that we expect going ahead. On the retail, we are investing, and that's why when I, in my opening remarks, I talked about the overall investment that we are making in distribution and technology. So retail indemnity, the health agency team that we are scaling up, obviously at this point in time is reasonably high combined ratio. Our sense is that it will take a couple of years for us to see that coming in line with our numbers, because we want to keep on investing in that segment for some time, at least for the next couple of years.
So the next 5 years out, would 95% combined for health be a number that we can work with? So I understand it will be a build up and then things will scale up. So just wanted a more longer term picture.
I always am very worried about predicting 5-year out numbers, because none of us can predict 5-year out numbers. My sense is that, of course, the combined would obviously come under much better control. I do not believe that the number can be a low 90s that some people articulate. We don't believe that can sustain in the Indian market. So you have to operate at combined ratios which are maybe closer to 100, not closer to 90.
Got it. That is helpful, sir. Thank you so much for this. All the best.
Thank you. The next question is from the line of Prateek Poddar from Nippon India Mutual Fund. Please go ahead.
Yeah, sir, hi. So just one small clarification. Did I hear you right saying that, you have diluted your ROE aspirations for growth, and hence the journey towards 100% combined ratio might not be something which we would look for?
Yes, what we've been saying is that we would want to invest in some of these segments of business, largely digital and health agency, and we had said that while we, on the integrated basis, on a pro forma basis, we were about 104 odd number, if you look at a 2020 pro forma. we had said that we would want to bring it down closer to our normal target number of 100, but we do want to invest a bit in terms of scaling up these businesses. Towards that, if the ROE comes down below 20, we are okay. It will be in the high teens, may not be 20%.
But sir, is this because of competitive pressures that, or it is just a more strategic question or a thought process? Like, what has changed for you to, I remember earlier in our conversations, always the focus was on ROE and, not diluting combined ratios. Looks like there has been some change in this.
So bit of both. Honestly, if you see on the health side, it's more strategic because of the investment that if you remember some of the conversations that we've had, that on the health indemnity side, we were building up some of the capabilities, both in the outpatient OPD product and the I'll Take Care app. Now that we've done that, we want to scale up the business. So that's a strategic call. The rest, of course, driven by current context in the market. If the market remains very aggressive, then we don't want to kind of lose market share beyond a level. If, however, market corrects, there will be an opportunity to bring combined down into our comfort zone. But at this point in time, it's a bit of both. Investment both in the agency and also in digital to scale up the business for the future.
Got it. Thanks. Really helpful, sir. Thank you and all the best.
Thank you. The next question is from the line of Hitesh Gulati from Haitong Securities. Please go ahead.
Yeah, thank you for giving me the opportunity. Sir, out of the 88,000 agents that we have mentioned, how many would be selling health for us? And also in continuation with health, ICICI Bank has started selling indemnity. How much of this can be kind of go up? What can be the growth path here? And also, is there any update on HDFC Bank and Axis selling health for us or after Bharti AXA partnership?
So let me take it in the reverse order. So in terms of the the key banker partners that we got through the acquisition, we are very happy with the way those partnerships are developing. As of now, they are primarily focusing on SME and motor products, but I'm sure there will be opportunities to distribute health in due course. And if you see the growth of that channel, while the aggregate banker partners of BAGI, as we said, is grown at about 15.9%. I think these two partners have grown even faster. So we are quite happy with the way that those channels are shaping up. Coming to your question on the bank business, look, I think we've been talking about the fact that we had a base effect because of the decision of the bank not to sell benefit policies for from Q3 of the previous year, and that had an impact for our this year number for 9 months. And we've been saying that that base effect will play out in this quarter. What the bank has decided to do is, rather than selling benefit, they're keen to sell indemnity. So we've kind of structured suitable products for the bank and we've launched it. I don't want to give any guidance on whether the number will go up or down because at this point in time, we just started selling some of these products. We will see how it goes along, and then we will see what numbers we see. But at least the base, the negative base that we had of the benefit book being there the previous year and that business being stopped this year, that effect has now gone.
And your last question on Hitesh, on the number of health agents within that number will be about 6,000.
Okay. So last quarter we have added about 8 to 10,000 agents, so not all of them are obviously health.
We have 3 separate agency channels. One is motor, one is health, one is SME. Of course, we work across the channels and try to cross them, but we have dedicated channels for the 3 segments.
Okay, and so just last, if I can squeeze in, our advance premium number for March is lower than December, so that means motor TP growth is more towards CV. Is that understanding correct, or it is towards renewal premiums?
A combination of both, Hitesh. I think relatively you're right to some extent, given the fact that, let's say, the contribution of CV in the overall motor growth is also kind of higher in FY22 compared to FY21, so that's obviously one contributor. Having said that, I think equally, if you look at some of the older, as what we had said even at the time when these long-term policy guidelines had come in, we had said it will start to kind of peak maybe after attaining almost about between the third and the fourth year, this number of advance premium will pretty much start to kind of peak. Because you will obviously start to have the incremental numbers on advance premium will be more reflective of what kind of growth that we will achieve on the motor portfolio, which is what we have seen in FY21-22. This is the year where it's been almost about 3 years since the time the new long-term guidelines had come. So hence that's the reason why you see a small dip in so far as the advance premium numbers at 31st March is concerned.
That's the other thing that we've been saying, that new vehicle sales both for private car and two-wheelers have been quite low. That has also had an impact.
Sure, sir. Thank you. That's it from my side.
Thank you. Next question is from the line of Investec. Please go ahead.
Thanks for the opportunity, sir. Two questions. Firstly, a lot of insurtech companies are scaling their POS agency business. So how do we view this business? Do we see it as a threat or opportunity for us? Secondly, in the new private cars segment, have we lost all the market share trends in that segment? Have we lost market share or gained market share in last 1 year? And just in the new private car segment.
So Nidesh, again, second question first. In the 9 months, we lost market share. That's why our, if you see our motor numbers were quite low in the, relatively lower in the first 9 months. This quarter we have not lost as much. We've lost a little bit in the private car side, but made up in the two-wheeler and the CV side for the quarter. And our sense is that even on private car, the recalibration or the portfolio alignment that we wanted to do, given the pricing aggression, is largely behind us. So we hope to see market share even in private car segment being held on. Coming back to your first question on InsurTech, look, at this point in time, we are partnering with almost all of them. In terms of whether in the long term it's positive or negative, there's one positive in terms of them potentially expanding. As of now, they're not expanding the market really because they're more playing like aggregators, aggregating existing agents under their umbrella. But we hope that in due course they will expand the market and grow. And we are at this point in time we are working with all of them. On the POS side, we are not with the digital aggregator, but on this segment we are working with them.
Sure, sir. Okay. Thank you, sir.
Thank you. The next question is from the line of Nischint Chawathe from Kotak Securities. Please go ahead.
Hi, am I audible?
Yes, Nischint.
Yeah. My question actually pertains to the last 2 slides of the presentation. And I think what you mentioned is that based on the revised disclosures, you have split the reserving, triangle disclosures between motor, TP, and the others. Now, I think what we can see over here is that the releases in the other segment is higher than motor TP. If I look at it, over the years. So how should one really be reading it? What is the interpretation of it? Is it something that you're reserving as a little more conservative in the other segments? Or, if you could just help us interpret this.
So Nischint, if you look at, so far as approach to reserving is concerned, fundamentally there is no change in terms of the process that we follow for the current year relative to, let's say, what approach we have been following over the last several years. And the approach is to kind of reserve conservatively at source. And as and when each portfolio kind of starts to develop in terms of loss experiences, you will possibly see whether the reserve estimates that we made at source was adequate or not so adequate. In some of these lines, the conservatism of reserving will start to play out faster. However, in certain long tail lines of businesses, that will obviously take a relatively longer time for you to reflect whether the reserves that we carried at source were adequate or not. Slide 29 and 30, the point that you made, other than motor third-party lines of businesses are predominantly which have a relatively shorter tail insofar as claim settlements is concerned, which is why the play out of the actual loss experience tends to be faster, and you are able to kind of see relative to the amount of reserves that we carried, you are able to see, let's say, small amount of reserve releases. However, insofar as the third-party book is concerned, as I said, that's a book which is long tail, and obviously it takes a longer horizon before which one can say whether the amount of reserves that we have kind of built in is appropriate or not. Having said that, if you look at the information that gets put out whether it is for motor third party or whether it is for the other lines of businesses other than third party. The information is given for the last 10 years. And you can see over the last 10-year cycles, even after 10 years of development, both with respect to the motor third party triangles that you see as well as the other than motor third party triangles, basis the loss development experiences, our approach to reserving has played out to be conservative at source, and both of them reflect small amount of reserve releases in the portfolio.
And if I can add to what Gopal said, we are actually very happy that this disclosure is mandated by the regulator. We've been asking for this disclosure for a long time. We were the first company to disclose, and now we are seeing more disclosures. It's not just the two, pool and aggregate. There are further disclosures of TP business for the running book and the non-TP business, which is a very good development.
Perfect. Thank you very much.
Thank you very much. Ladies and gentlemen, we'll take that as the last question. I now hand the conference over to Mr. Bhargav Dasgupta for closing comments.
Thank you everyone for joining. And again, if you have any other separate questions, feel free to reach out. We'll be happy to take them separately. Thank you again.
Thank you so much.
Take care and good night.
Thank you very much. On behalf of ICICI Lombard General Insurance Company Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.